So we are coming to continue our discussion for the final discussion on leases, and we know that we are done with the IFRS 16. So, but I will update you on the standards that we are going to be looking at. So I will update you on the standards and the schedule. So, but the next standard will be financial instruments, IFRS 9. Okay. But the leases, we are coming to look at what we call reassessment of lease liability, which is almost likely to be a corporate reporting question. But financial reporting, still, they can still bring this question in your exams. Okay. We have looked at lessor accounting. We have looked at leasee accounting. We have also looked at the sales and lease back. What are we saying is the reassessment of lease liability? You see, all the questions that we have looked at under leasee accounting, lessor accounting, you can see that the lease renters, the rate implicit in the lease, and other things are all constants. All the things that we have used, they are all constants. So the rentals is fixed for 5 years. So if it is 20 million, it will be 20 million throughout. That is a question that we have solved. The rate implicit in the list, we can see that the questions that we have solved, they are also what? Constant. But the question is, what if there is a change in any of these variables? What will be the impact on the lease liability? So what if we are using 7% as a rate implicit? After 2 years, we have now agreed that no, the rate implicit in the lease should be what? 9%. The lease liability will not be the same again. The lease liability will not be the same. So what we are going to be looking at as a reassessment of the lease liabilities, what if there is a change in any of the variables that we have used to calculate the lease liability? The question that we have solved, the years were what? The same. But what if we have now reduced the lease period? The lease liability that was initially estimated will not be the same as the new one based on the new agreements now. So we have to reassess. We have to re-estimate the lease liability. That's what we mean by the reassessment of the lease liability. So but the question that we have solved, everything is constant. And we assume that the lease period will be 7 years. The rentals will be 10 million. And the rate implicit in the lease will be 10%. But what if any of these variables change? What is any of these variables? There's a change in any of these variables. What will happen? The lease liability will not be the same again. That's what we are coming to look at under the reassessment of lease liability. Okay. So what if there is a change? We have to re-estimate the lease liability. All right. What will be the impact on the right of use to again? Okay. It depends on how the lessee is carrying the right of use. So the lessee can be using the cost model. So the lessee can be using the cost model. Okay. If the lessee is using a cost model and after reassessment, there is an increase in the lease liability. What if after the reassessment, there's an increase in the lease liability? So the lease liability was 200 million, but after the reassessment, let's say it is now 202 million. It has increased by what? 2. Okay. The meaning is that the time that we are calculating the right of use, we use only what? 200 million instead of what? 202. So if they are using cost model, any increase or decrease in liability will be what? Will have the same effect on the right of use. So if there's an increase in the liability, the increment will also be added to the what? To the right of use. So you increase the right of use in the same amount. So you go and add the 2 million to the right of use. You go and add the 2 million to the right of use. All right. But since we all assume that the leasee is going to be the default method is the cost model. Since the default method will be the cost model, then we increase the right of use. If there's a decrease, we are going to subtract the same amount of the difference, which is a decrease from the right of use. What about if these people are using revaluation? If they are using revaluation model for the asset, what will happen? What will happen? The question will always tell you that the question will always tell you that maybe the question can tell you that the asset will be revalued together with the together with the lease liability. If that is the case, then any change in the lease liability will be treated as what? A revaluation surplus or a revaluation loss. But if we are valuing only the assets, not with what? The lease liability, then any change will be treated like how we are treating it under the cost model. Okay, so that's the revaluation model, which is you will not see most of the leasee carrying right of use under the revaluation model. Then any increase or decrease should be treated like how we do it under cost model. If there's an increase, the increase will be added to the right of use, and the increase will also be added to the what? To the existing lease liability. Any decrease, the decrease will be taken away from the right of use, and the same amount will be taken away from the existing lease liability. So the reassessment is just what if there's a change in any of the variables that we use to estimate our lease liability? What will be the impact? Okay. And we are also going to be looking at what we call a sub-lease. Okay, you have leased an asset from someone, and you are also leasing that particular asset to a different person. So it will now be a 3 parties to the lease. How do we go about that? We also look at that particular one, and we know that we are done with everything. Okay. So let's pick some questions on that. So the question, this one is IC November question. You can go and check that one. And the question 10 is a mock question for corporate reporting people. So this will be the question that will come under list in your mock. So I will not solve this one. Go and solve it yourself. Okay. So let me see. Okay. Let me pick question 11, question 12, and see if I can pick another question. Okay. Question 11. Who is reading for us? Question 11. Question 11. Who is helping us with the question 11?
Question 11.
All right.
On 1st January 2020, PL leased a plant from Bubu Limited for 8 years at 30 million Ghana cedis, payable annually in arrears. On that date, fair value and useful life of this plant were 170 million Ghana cedis and 10 years respectively, whereas PL's incremental borrowing rate was 12% per annum. On 1st January 2021, the lease contract was amended with mutual consent by reducing the original lease term from 8 years to 5 years with the same annual payment. PL incremental borrowing rate on 1st January 2021 was 14% per annum required. In line with relevant IRS, show how PL will account for the arrangement for the year ended 31st December 2021 in its financial statement.
All right, thank you. So you can see that there is a change in what? In the variables, or one of the variables that we are going to be using to what? To estimate our initial lease liability. They have now reduced the lease period from 8 years to 5 years. Okay. But this arrangement or this amendment was done a year after the lease. So the first thing is that you first of all has to calculate your initial. How would this particular transaction be accounted for in the books of PL at the time of what? The lease. So that will be on 1st January, we will account for this one for the first year. Then it will be in the second year that the arrangement will change. So we have to do it first before the amendment. So let's pick that question 11. Okay. So the lease rentals is what? How much is the lease rentals every year? How much are they paying as the lease rentals every year?
3 million.
30 million. Okay. So 30 million. And lease period is what?
8 years.
8 years.
Oh.
Okay. What is the rate that we are going to be using?
Oh.
If you are not giving a rate implicit in the lease, you use the borrowing rate of what? Of the leasee. What is the borrowing rate of the leasee? The incremental borrowing rate.
12.
12. Okay. So that will be 12%. Please, don't be in any way be what? Be tempted to use the fair value of the plant instead of what? The lease liability. Unless your lease liability, your estimation of the lease liability or your right of use is the same as what? The fair value. If that is not the case, you are not giving the fair value. You are not paying the fair value of this one. So you have to ask yourself, how much are you owing the person? We are not concerned about how much the person bought the item. That is none of our business. But how much are we going to be owing the person? How much are we paying for the asset that we are taking? How much are we paying for the asset that we are taking? So sometimes they can give you the fair value to also determine whether it is a finance lease. Last time I was saying that if it is a finance lease, you see that the lease liability will almost be what? Or will be more than half of the fair value, or will be the same, or will almost be the same as what? The fair value. So sometimes they can also give you the fair value as a factor which you are going to be using to determine whether it is a finance lease or it is operating lease. So don't be tempted to use a fair value. That is none of our business. How much are we promising to pay the person? What is the today's value of the amount that we are paying? That is the right of use. That is the amount that we should pay today, not the fair value. The fair value will be used for the lessor if he's doing the lessor accounting. Okay, so initially we are saying that we are going to be leasing this particular asset for 8 years and 30 million. You can see that it is more than what? Half of this year, or it is almost half of this year, or more than half of the useful life of the asset. That is a finance lease. Okay. Then let's come to the let's do it one by one. Since it's a reassessment of lease liability, I have to be very careful about the presentation. So the date will be very important here. So let's come to initial recognition. Initial recognition. The initial recognition, I'm talking about January 2020. How do we recognize this? Okay. What is the first thing that we have to do? How do you recognize the lease? At the date of inception. What are the things that you do? Okay. This, don't say we are doing reassessment of lease liability. So all the things that you have learned under lease are no more applicable. No. The only thing that is changing over here is that you have to re-estimate or you have to recalculate your lease liability. That is it. So the initial recognition will still be the right of use and then the what? The lease liability. So let's estimate our lease liability. That will be, we have years, we have the cash flow, we have the discount factor, then we have the present value. The discount factor will now be 12%. And our cash flow, our years, we are doing this for 5 years, and this is 8 years rather, which is in arrears. So we use annuity 1 to 8. Don't go to the exam and be doing 1 year, 2. No. The cash flows are the same, 30-30. So if you are doing that 1-1-1, you are wasting your own time. Just use annuity and move on. So
Hello, sir.
yes, please.
Are they not going to take those ones?
And if you do it like that, they have a tick. And if you look at the suggested solution, the examiner will use annuity, or the examiner will say someone can use annuity and someone can also use the 1-1-1-1. So the mark that you are going to be getting, the same person will also get the same mark. So they will allocate the marks based on those who are using what? Annuity. If you're able to present everything right and you use annuity, you will get the 8/8 or the 6/6 that will be given. If you also present it one by one, at the end of the day, you also get the 8/8. If you have done everything correctly, you also get the 8/8. Who is being smart here? The one using annuity. The focus is not about the calculation of the lease liability. The focus is the treatment, the accounting treatment of the transaction. So you calculating finance costs, the depreciation, presenting the lease liability, and all those things. That is the purpose of the question. But the lease liability is just a working to those ones. So use the annuity and move on because of time. What if the lease is for 20 years? Will you be doing it 1-1-1-1 for 20 years? No. So use annuity unless the cash flows are not constant. Then you can use your 1, 2, 3, 4, 5. All right. Let's count to annuity for 8 years, 12%. What are we getting?
4.97.
4.97.
4.97. Okay. Is it 4.9? Okay, 4.9.
4.97.
Okay. 4.970. Okay. What are we if you multiply?
149.1.
149.1. So this is the lease liability. Okay. So do we have any direct cost incurred by the lessee? No. So it means that this is the amount that we are owing. It means that if we should have money today, this is the amount that we should pay for the assets. So since there's no direct cost and everything, this is the value of the asset that we are purchasing to. So the right of use will also be the 149 point, this one. Sometimes they can also tell you that the lessee has the right to decommission the asset at the end of the useful life. How do we deal with the decommission cost under provisions I-37? You have to find a present value and add it to this one. Okay, so last time I told you that the right of use is accounted for. The right of use is accounted for using the right of use is accounted for in line with what? IAS 16, property, plant, and equipment. So all those things that you'll be adding over there will be added to the right of use. The lease liability is just the amount that the present value of the amount that we should be paying for the asset. So any direct cost, any decommission cost, any borrowing cost will always be added to this. So let's count to the subsequent measurements for this year. Subsequent measurements for this year. Subsequent measurement will be December 2021. So at the end of the year, what are we going to be? Okay, December 2020 rather. What are we going to be doing? We are going to be depreciating our right of use. So depreciation of 149.1 divided by 8 years. Is that correct? What are you getting?
Yes.
What are we getting there?
18.64.
18.64.
Okay, 18.64. Okay. Then what will happen? We have to increase our what? Our lease liability. We have to find the interest because the lease liability, since we are not paying the money today, the person has factored in time value of money. So we have to be looking for the interest that we supposed to be paying. So we come to the lease liability at start. That is at the beginning of the year. Please don't go and be using amortization table or lease amortization table. No, you are going to do this one for only 1 year. We only use the table when they are asking you to do the lease or show the workings for the lease over the lease period. So for that one, you can do your year 1, year 2, year 3. But since it's only 1 year, you can just use the vertical one and move on. Okay, so we have the 149.1. Then we have the finance cost. Okay, the finance cost will now be 0.12 multiplied by 149.1. What are we having?
17.8.
17.88.
Okay. I'm having 17.89. Okay. At the end of the year,
Yes.
at the end of the year, what will happen?
Right now.
Okay, we pay the renter. So we pay to reduce our payment of renters. We are going to pay to reduce our liability, and that will be 30. So what will now be the 14.1 plus 17.89 minus 30. Okay. What are you having? 136. I'm having 136.99. Is that correct?
Yes.
No.
136.99.
Mhm.
Okay. What will be our balances at the beginning of January, at the beginning of the current year, which is January 2021? What will be our right of use? Okay. The focus is not about showing the what statement of profit or loss for 2020. No, they are asking you to do this for what 2020. They are asking you to do this for 2021. That is what the question is saying. But you can't do the 2021 without you calculating the figures for 2020 or without you doing the initial recognition. Before the amendment, how was the leasee accounting for this? That's what we have done. They have accounted for this in the first year. But the focus is to show the extract for 2021. But we can't show the extract for 2021 without 2020, because 2020 was the lease period, was the period that the arrangement was done. So we have to do the accounting treatment for that. But the focus is 2021. So let's now look at the balances. After the 2020, what will be the balances for 2021? Yeah, Deborah.
Hello, sir. So the statement that they made that the payment is made 30 million annually in arrears, does that mean that it is made at the end of the year or before the year starts? Because you see, some of the purchases we sometimes saw, when is that we don't subtract the rental payment. So I want to know the difference between the periods whereby we won't subtract the rental payments, but at that point we will subtract the rental payments to get the closing figure.
If they say the payment is in arrears, it means that at the end of every year you pay. Okay, so the payment is done at the end of every year. They will say the payment is done in advance. So it means that at the time that we are going to be making the arrangements, we make the payment at that date. So the first year payment will be made at the date of the inception of the lease, which is the date that the arrangement was done. So if the lease has been agreed on 1st January and they see the payment is always done in advance, it means that you have already paid the first renters on 1st January already. So at the end of the year, you will not pay, but you pay at the beginning of the subsequent year. But if they say the payment is done in arrears, it means that you are going to start using the assets At the end of every year, then you pay. At the end of every year, then you pay. So from the beginning to the end of the year, you won't pay. So that is why we always charge the interest on that amount. And at the end of the year, you pay the 30 million. It's just like how you are servicing the loan. So at the end of the year, you pay the loan. So they will charge the interest with the amount that you are owing them. Then at the end of the year, they will reduce your debt by the amount that you are paying. So the question will tell you in advance or in arrears. In advance, there won't be any deduction for the year. But before you start the next year, before you start with the calculation for next year, the people will pay before you start with whatever you are going to start with. All right. So let's count to the right of use. The right of use, what will be the balance on the right of use? What will be the balance on the right of use? Would that be 149.1 minus 18.64?
Minus 18.64.
Okay. What will be the balance? That will be the carrying value.
130.46.
130.46. Okay. So let's come to the lease liability. The lease liability, what will be the opening balance? That will be the 136.99. Okay. Let's now count to what is happening. So let's count to, let me just put a reassessment here. Since some of us, this is the first time that we are looking at this. So the presentation has to be as if you haven't heard about this before. So what is now on January 1? What is happening? What is the question saying? What is happening? On January 1, the lease contract was amended with mutual consent by reducing the original lease term from 8 years to 5 years with the same annual payments. The PL's incremental borrowing rate on 1st January 2021 was 14%. What is happening now? They say that the lease period is supposed to be 5 years, not 8 years. Okay, but on 1st January, how many years how many years rental are we going to be paying? We are left with how many years rentals if the lease period should now be 5 years. And the agreement was done on January 2020. Now we are doing this on January 2021. We are left with how many years lease to pay?
4.
That will be 4 years. So it means that we have done 1 year. The lease period is now 5 years, but we have already done 1 year, left with what? 4 years. Okay, so you have to now calculate your lease liability for the remaining what? 4 years. So the period is no longer 8 years. It is now 5 years. We have already done what? 1 year. It means that we are left with what? 4 years rental to pay. And that 4 years rentals to pay, what would have been the what? What would have been the amount? Please don't say you are going back to calculate the rentals as if what? It is 5 years was given to you on 1st January 2020. No, this is a change in an estimate. So the treatment should not be a prospective anything. All right, this is a change in an estimate. The treatment should not be retrospective. It should not be retrospective. So you just calculate from now to the end of the lease period, how much am I owing the people? And that will give you the actual lease liability figure. So let's do the reassessment. We have the years and we have the cash flow. We have the discount factor. Then we have the present value. Okay. So the years will now be 1 to 4 because it's supposed to be 5. We have done 1 already. So we calculate the new lease liability in the year of amendment. What is the cash flow now? The cash flow will be what? Will be 30. The discount factor will be what?
40.
Okay. You use the incremental. The arrangement now will be based on the 14%. So 14% annuity for 4 years.
2.914.
2.914. What are you getting? If you multiply, what are you getting?
$87.40.
87 point what? 42.
40.
Okay, so this is supposed to be 87.42. Okay, so this is the amount that you should be having as lease liability now. But what is the lease liability in your books?
$136.99.
Okay, 136.99. So what is going to happen? So we debit the lease liability. So how much will be the reduction?
$49.57.
So 49.57. Okay. The same 49.57 will be taken away from the right of use. So 49.57. So you have to reduce your lease liability to 87.42. And the same reduction will be done to what? To the right of use. There is no profit, there is no loss here. It is just we assume that they are carrying this one at cost model. So the reduction should be taken from the right of use and also the lease liability. So our new right of use now be what? What will be the right of use for this year now? What will be the right of use now? The new right of use will be what?
80.89.
Oh, okay. So minus 4 to 9.57.
89.
Okay, 80.89. Okay. And the lease liability will now be the new one that we have calculated. That is what we call the 87.42. Please don't go there and be thinking that, okay, if they are now amending this particular lease, it means that this amendment should be there at the beginning of the lease or at the inception of the lease. No, this is a change in an estimate. So forget about whatever will happen from the time that the agreement was made. No, it should not have retrospective effect. The effect should be treated from what? From the year of what? The amendment. This is a change in an estimate. So just calculate a new one and move on with whatever treatment that you are going to be having. Don't say that the depreciation was overcharged. That is none of your business. It's a change in an estimate. We are just estimating. The lease liability is an estimate. So if there's any change, it's a change in an estimate, which should be having what? A prospective effect, not retrospective effect. So sometimes overthinking can make you do things that are not necessary. All right. So this is a change in an estimate, not an error, not fraud, not a change in accounting policy, which should be treated retrospectively. So just calculate whatever you have to calculate for the current year. Adjust it for the current year and move on. So let's come to the end of this year now. December 2021. Okay, December 2021, we now have a depreciation. We now have a depreciation of 80.89 divided by what? What would be the number of years?
4.
Okay, 4. Thank you very much. So that will be 4 years now. Okay. Then what are we going to be having? 80.89 divided by 4. I'm having
20.22.
okay, 20.22. Okay, let's count to our lease liability at the end of the year. So we have lease liability. We have lease liability. And we have balance January 2021. What is the new balance? 87.42. Okay, that is a new liability now. 87.42. Okay, then we have the finance cost. The finance cost will now be based on the 0.14 multiplied by 87.42. Okay, what are we having?
11.8.
7 points. Are you sure? I'm giving
12.2324.
Okay, 12.24. And at the end of the year, what will happen? The rental payment of 30. So what will now be the balance?
$69.66.
69.66. Okay, 69.66. Okay, I will use this opportunity to show you how you can separate the lease to current, the current one, and also the current liability and non-current liability. Okay. At the end of every year, we are paying what? 30 million, isn't it? Okay. This 30 million consists of principal payments and also the interest payments. Okay. And the interest payments will always, or the interest will always be charged at the end of the year. So it presupposes that we are paying the interest at the end of every year. But the principal payments can be done at the beginning of the year because the principal, we are just paying the principal part, no interest. But the interest will be paid at the end of the year, or the interest will be charged at the end of the year. So we are paying the interest at the end of the year. So what you do is that this is the what? This is the opening balance for next year. What would have been the finance cost? You have to calculate this, the finance cost on the opening balance for the previous year. What would have been the finance cost? What would have been the finance cost there? That would be 0.14 multiplied by 69.66. How much are we having? Okay, I'm having
9.75.
Okay, so this 9.75 plus a principal, together we are going to be paying 30. So this interest will be at the end of the year, and this will be on the opening balance year. And at the end of the year, we pay 30. So interest portion of the 30 is 9.75 for the subsequent year. What will be the principal portion?
20.25.
Okay, so you just, if you want to separate, you just ask yourself, what will be the interest for the next year? The interest will be paid at the end of the year. And I'm paying 30 million. So what is the principal portion there? The principal portion will be, payment will be fixed throughout the year. So it can be, we can assume that it will be paid at the beginning, it will be paid at any time. Okay, so you just calculate the interest and take it from the principal. This will be the current liability. This will be the current liability for you. And the difference between this and this is the total liability. So this portion is what? Is the current. What will be the non-current? Non-current will be the total liability for the year, which is 69.66 minus 20.25. But if you cannot separate, just show your 69.66 as the what? As a non-current liability. Nobody will come and lash you in your house. No. Okay. It is better for you to get one tick than what? Getting nothing for the two. All right. It is not compulsory for you to show current, and that if you can show it, fine. If you cannot show it, fine. Are we okay? So let's come to the statement of profit or loss for this year. That is what they are asking, a statement of profit or loss. They say we should show this together with what? Comparative figures, or let me check. Okay, only in 2021, so no comparative. So statement of profit or loss for 2021. So we have depreciation.
Senior,
Yes, please.
sorry, the 20.25. How do you arrive at?
The 20.25. Are you okay with the 9.75? Please, can you hear me?
Yes, I can hear you.
Are you okay with the 9.75?
Yes, I'm okay with that.
Okay. How much are we paying at the end of every year? We are paying 30 million, isn't it?
Yes, please.
Okay. And the 30 million, there is interest component and also the principal component. So if the interest component is 9.75, what will be the principal component? And that is 30 minus the 9.75. So that's how come we got 20 points, this one.
Thank you. Thank you.
So the depreciation is 20.22. Then we have a finance cost for this year. Finance cost will be 12.24. That is it. Statement of financial position. You will now have the assets, which is non-current assets. Then you have the right of use. What will be the right of use now? 80.89 minus 20.22. What are we having? Then you have current liabilities. You have current liability. Then that will give you lease liability as current. That will give you the 20.25. And the non-current liability, that will also be lease liability. And that will be the difference between the 69.66 minus 20 points to 69.66 minus 20.25, 49.41. Okay. What is the right of use? What is the figure for the right of use?
$60.67.
Okay, 60.67. All right. So that is all. That is one side of the reassessment. If it is the lease period that is changing, what if it is the rate or it is the rentals that is changing? What do we do? The same calculation. The same calculation. You have to reassess your lease liability in the year of change. Let's look at a question and see what we can do there. Okay. Question number 2.
Hello, sir.
Yes, please. Finish.
Please, with the reassessment, why did you use 1 up to 4, but not 1 up to? Reduce from 8 to 5.
Okay, they say on January 2021, the lease contract was amended with mutual consent by reducing the original lease term from 8 years to 5 years with the same annual payment. They have reduced the original from 8 to what? To 5 years. The time that at the time of the amendment, what is the remaining useful life on what is the remaining period on the lease based on the original? We have done 1 year already. Okay, so we have 7 years remaining. And they are saying that the original, which was 8 years, has now been what? Revised to 5 years. It means that the 5 years should be from January, but we have done 1 year already. So we have remaining 4 years on the list.
Okay.
So the change was not from this date. It's not that it has now been revised to 5 years from this date. Then if that is the case, then it means that the lease period will be 6 years. But the original, the time of the inception, which is January 2020, the lease period should have been 5 years from there. But we have already done 1. So we have a remaining 4 installment to pay. All right.
Thank you.
You're welcome.
So please, can you go back to the white screen again?
The
whiteboard.
Okay.
Thank you, sir.
All right. Let's take the last one. Let's take the last one. Question number 12. It's very simple, but it's complicated. Senior, can you take the 12 for us?
Okay. Question 12. On 1st January 2020, BL acquired a building on lease for a non-cancelable period of 4 years at 45 million Ghana cedis per annum payable in arrears. The agreement contains an option for BL to extend the lease for further 3 years at 45 million cedis per annum payable in arrears. On 1st January 2020, BL's incremental borrowing rate was 15% per annum, and BL was not reasonably certain that the option to extend the term will be exercised. However, on 1st January 2021, BL was reasonably certain that the option to extend the term will be exercised due to increasing rentals in the market. BL's incremental borrowing rate was 14% per annum on that date. On 1st July 2021, BL sub-leased this building for a lease term of 5.5 years at 24 million payable semi-annually in advance to XY. The initial direct cost of BL in this lease agreement with XY is 1 million Ghana cedis. Required. Show the suitable accounting treatment of the above transaction in the financial statement of BL for the year ended 31st December 2021. B. If BL leased the building to XY for only 2 years, show the effect of the sublease in their financial statement for the year ended 31st December 2021.
Okay. This one, the 2 years, should not be there. If it is only 2 years, that will be an operating list. So I should have removed the 2 years from there so that we account for it in the perspective that I want to do it. Okay. So let's see. So they say show the suitable accounting treatment of the above transactions in the okay. So it means that the sublease and everything will be part of the A. And they see the B, if it is not the 5.5 years, it is 2 years, what will be the treatment? So if it is 2.5 years, that will be operating list. But for 5.5, that will be a finance list. So let's look at this question. Very simple. All right. So we have question number 12. How do we go about it? So say your mind before we move on. The first time. So in the first year, what will be the lease period? In the first year, January 2020, what will be the
4 years.
Okay, because they are not certain. The option, you can only include the option if they are certain that it will be what? It will be exercised. So they are not certain. So they are still going to be looking at a non-cancelable period of 4 years. So we have to calculate the lease liability in what? 2020. If in 2020, how are they accounting for this? So in 2020, January 2020, they estimated that they are only going to be leasing this for what? For lease liability will be, so we have the years now, we have the cash flow, we have the discount factor, then we have the present value. So this will be 1 to 4. Okay, the cash flow is how much? What is the lease amount that they are paying? How much? How much are they paying?
45 million.
Okay, 45 million. What is the incremental borrowing rate for them at that date?
15%.
15%. Okay. What is the annuity? For 15% for 4 years.
$2.855.
Okay, 2.855. What are we having if you multiply?
So 128.48.
Okay, 128.48. Okay, so 128.48. That is the lease liability. What would be the right of? What would be the right of use also? The right of use will also be the 128.48. There is no direct cost on this particular transaction. So this is the amount that we're supposed to pay for the asset. This is the actual amount of the asset, but it's because of the interest that we are going to be paying 180 Ghana cedis. So the difference over there is the what? Is the interest element. So first we have been using the number of years digit to find the what? The finance cost. But now that was in IS 17. Now we are only using the actual or we are using the amortized one where we calculate only we use the rate to calculate the interest. Okay.
Five. Why is it?
At the end of this year, 2020, this transaction, we are going to be depreciating our right of use, 128.48 divided by 4 years. Is that correct?
Yeah, divided by 4 years.
Okay. So that will give us how much?
32.1.
32.12. And our lease liability, we have to calculate finance cost on the lease liability and also know the lease liability at the end of the year. So we have the figure at January 2020, which will be the balance. So we have 128.48. So since this is done in arrears, we have to calculate the finance cost first before we pay the renters. So 128.48. What are we having?
$19.27.
19.27. Then what will happen? We pay the rental payments. So payment of the renters. Okay. So what will happen? The rental will be 45. Okay. So what will be the lease liability at the year end?
102.75.
Okay. All right. So this will be, let's go to the opening balances for the current year, which is 2021 that they are talking about. So January 2021, our right of use balance will be what? What will be the value of the right of use? That will be 128.48 minus 32 point what? 148.28 minus 32.12. We have used 1 year already, so remaining 3 years. That will give us how much?
$96.36.
Okay. I'm getting 116.16. Can you confirm that? Okay, 128 rather. Okay. 128.4.
128.48.
Okay. So that will give us
96.36.
96.36. Okay. And the lease liability will be what?
102.75.
Okay, 102.75. So this will be at the beginning of the year. But let's count to the arrangements that are happening in the year now. Okay. They are saying that, however, on January 2021, there was reasonably certain that the option to extend the term will be exercised due to increasing rentals in the market. The bill's incremental borrowing rate was 14% per annum on that date. So based on the original arrangement, how many years do we have? How many years is left on the, how many years of the lease period is remaining in the what? In the current year now, January 2021. How many years do we have left on what? On the lease?
3.
Okay. And they are saying that we are also going to extend it for what? 3 years. So the lease period will now be what?
6.
Okay. So the lease period will now be 6 years. Or in all, it will be 7 years, but we have used only one. Okay, so we have 3 years remaining, and we are going to extend it for additional 3 years. It means that a new lease period from January now will be 6 years. It means that the lease liability that we are having for 3 years will not be the same as for 6 years. This figure over here is for 3 years, but we are now going to extend the lease liability for additional what?
5 years.
3 years. So it means that we have to calculate the 3 years and also add it. So what we do from this place is that we now estimate or reassess our lease liability. We now reassess our, so reassessment of the liability. The reassessment, we now calculate from today. Now we have 6 years rentals to pay. So we now calculate our new lease liability based on the years now. So that will be the discount factor here, and that will be the present value. So we now have 1 to 6. That the cash flow will still be 45. Then discount rate will be 14%. Okay, what are we getting? Discount factor 14% for 6 years.
3.889.
Can you take it again?
3.889.
3.889. So if you multiply, what are we getting?
175.
175.
Right.
Okay. So we have 175.46. Is that correct?
It's 175.005.
Hey, let me do that again. 45. Is it 45 or okay? 45. 45 multiplied by 3.889. Okay. 17.00. That will be 01. Yeah, let's okay. So the new lease liability now will be 17.01. Okay. All right. So, but what is the lease liability in our books?
$102.72.
Okay. What is the increase now?
$72
72.6.
point.
72 point.
2.27.
Okay. So increase the lease liability. Increase the lease liability. Increase the lease liability and the right of use by 70 what?
72.26.
72.26 million. Okay, so let's count to this. Let's go to the question now. Okay.
So, sir, is it better to write or to pass the journal?
You are going to be using the new figures. So the meaning is that you have already added, but you just write increase the right of use and the lease liability by that amount. Or you can also add. There's no problem with that. Okay. Let's come here. On July 2021, Bill sub-leased this building for a lease term of 5.5 years at 24 million payable semi-annually in advance to XL. The initial direct cost of Bill in this lease arrangement with XL is what? 1 million. Okay. So it means that the BL has used the asset for what? The current year, 2021, they have used the assets for how many months?
6.
6 months.
Okay, after the 6 months, they have now leased the asset to what? To a different company, isn't it? Okay, look at this lease arrangement. Can we say that it's a finance lease or operating lease? 5.5 years out of the 6 years.
The finance lease.
Okay, if it is a finance lease, then the BL will now become what? A lessor. If the lessor is engaging in a finance lease, what happened? The lessor has to de-recognize the asset from his books and recognize what? Lease receivables. So we are going to be calculating, but BL will still have what? BL will still be owing what? The original what? Lessor. So the BL will still have the lease liability in their books. But the right of use will no longer be there. The asset has now been given to XY. Okay, so what will happen is that we have to depreciate the asset for BL for only 6 months to know the value of the asset before the lease was done. Okay, let's come to depreciation. So the depreciation will be, what will be the new value of the right of use now after adding the 72.26?
To be 168.62.
Okay, 168. Okay, 168.62. Okay, divided by, would that be 6 years? Multiplied by 6/12. What are we having? I'm having 14.05.
05.
14.0.
Okay.
How did you get 168.62? Forgive me.
You
Yeah.
add
Hello, sir.
Yes, please.
It's rather 103.6.
what?
103.6. The depreciation. 103.62 divided by 6.
14.0.
96.36 multiplied by 72.26. What are you getting?
No multiply is plus.
Plus
It's
72.
adding or multiply. It's adding.
It's adding.
Which one?
The increase in the
right of
liability.
use depreciation.
The right of use of what?
Depreciation. Yeah.
Okay. Which one? The current one that I've gotten, the 14.05.
The balance at start was 96.36.
Okay. Then you add what?
And we added 72.26.
Okay.
So it will be 103.6.
Are you sure?
No, it will be 168.
103. Senior. 90 plus 70 is almost 160. You're okay now?
Yeah.
Okay. Okay. Someone was asking about how 168. I hope you are that person, that particular person is also okay too.
Yeah, I'm okay. I'm okay, sir.
Okay. So the negotiation will be for only 6 months. So let's look at the right of use at the date of the sub-leasing. The right of use at the date of the sub-leasing. That will give us what? 168.62 minus 14.05. What are we having?
154.57.
154.57. Okay. But for the lease liability, whether you are subleasing the asset or not, you will still be what? Owing the original lessor. So the lease liability will still be in the books for what? For the full year. It will be in the books. The lease liability, you are not going to derecognize the lease liability because you are still owing the original lessor. But just that the right of use will not be with you again. It will be now be transferred to a different person, and you also account for that one in your books. So the lease liability will still be the full year, which is in the books of the bill. So the lease liability, let's do the balance at the start. The balance at the start, which will be 15.01. Then we have the finance cost. Finance cost will be 0.14 multiplied by 17.01. What are we having? I'm having 24.50.
24.50.
Okay. Then we now have the rentals. The rentals will now be 45. Okay, what will be the balance now?
One 154.51.
154.59.
51.
Okay. They are the what 59 and 51.
51.
Okay. They are all the same. 59 pesos and 51 pesos. They are all having the same value. In terms of Ghana cedis, they are all the same value. But if it should be pounds or dollars, they are different because of how bad the currency is. Okay, so that is for the BL being what? Leasee. But let's count to BL being lessor. So let's count to BL being lessor over here. Yes, please.
Hello. On the part of the lessor, the 24 million payable semi-annually. And
that is what I.
And the what do you use for? How are you going to?
That is what I'm coming to do now.
Okay. All right.
Okay, so let's count to the BL being lessor. So how do BL account for this? BL has to derecognize the right of use. They have to derecognize the right of use in their books and recognize lease receivables, like how we do the lessor accounting. Okay, so let's come here. This was done on 1st July. Okay, so this was done on 1st July. BL subleased this building for a lease rentals of 5.5 years at 24 million, payable semi-annually in what? In advance to Excel. The initial direct cost of BL in this lease arrangement with Excel is okay. So with XY is 1. Okay, so the annuity, yeah. Some people might be asking, how do we calculate the annuity? Annuity is like this. Annuity formula 1 minus into bracket 1 plus R exponent negative n divided by n. Okay. So the R is the rate, the N is the number of years. Okay. All right. Let's come to this place. Okay. So this is they are paying semi-annually. They are paying semi-annually. Every 6 months, they are going to be paying. Every 6 months, they are going to be paying. Okay. Let's now come to the lessor accounting here. So if you are paying semi-annually and you are paying for 5.5 years, how many renters are you going to be paying within this particular period? Semi-annually. Every year you are paying 2 times. Every year you are paying 2 times. And you are paying for 5.5 years. How many times of renters will be paid?
11 times.
Yeah?
11 times.
11.
Are you sure? Okay, 11
times.
5 years
So
is
5.5 back.
okay. 5 years is
5.5 back.
okay. 5 years is 10 times. So the half on top. Okay, that will be 11. Okay, but this is paid in what? The renters are paid in what?
Advance.
In advance. So it means that one has already been paid at the date of the arrangement. Okay, so the lease receivables will be calculated on the remaining amount that we are yet to receive. So we are left with what? 10 rentals to receive from these people, because it is paid in advance. So at the date on 1st July, they have already paid the 24 million. So what is the remaining one that we are going to be receiving? That will be the receivables, because we have already received 24 million. So what is the receivables? The receivables will be the remaining one that we are here to receive from them. So we still use annuity here. We have the years, we have the cash flow, we have the discount factor, we have the present value. So we now have 1 to 10. 1 to 10 doesn't mean that it's 1 to 10 years. It is the number of times that we are going to receive the rentals. So we are now using what? 6 months. So that will be 1 to 10. Okay. Let's come to the,
Say,
yes, please.
can you take the formula for the annuity?
1 to 11.
I should kindly check what?
Divided by the
is
rate.
over R.
Divided by R, sorry. Okay.
So it's not 1 to 11.
Yeah?
It's not 1 to 11.
Check the question.
Because it's 5 years. 5.5 years.
Uh-huh.
We pay one already.
5.5
one.
years, 5.5 years, and the payment is done. How is the payment done?
Semi-annual.
Paid one in January and other one on 30th.
Who told you that?
I said we paid one already.
On which date?
6 months. It's 6 months. So one was in January and the other
one was in January. I can't hear that.
Yes,
part.
they have. The semi-annual.
When was the agreement done?
Right. 1st July.
Done on 1st July.
So if the agreement is done on 1st July, how will you pay for the asset before you even start the arrangement? Do you know that you are going to have that arrangement with the person? The advance payment will start from the date of the arrangement. Before you even have the asset on that date, you have already given 24 million to the person before you take the asset. That is the advance payment. So you start paying from 1st July, and the next one will be on 31 December. Then you start like that. So you are not going to pay January, no. You pay from the date that the arrangement has been done. How do you know? Do you know that you are going to lease this particular asset from the person before you pay? You pay on January without even using the asset. You pay from the date that you have taken the asset. So before I will start using the asset, take this particular amount of money. That is how the advance payment is done. Okay. All right. So let's come to the cash flow. That will be 24. Okay. What do you think will be the rate here? What rate will BL be using for this particular transaction? What rate would BL be using for this particular transaction?
$14.
Okay, but this is semi-annual. So what will happen? What will be the semi-annual rate?
7%.
7. So since you have changed the rentals to semi-annual, the rate that you should be using should also be semi-annual. Don't come and put the 14 here. If you are putting the 14 here, it means that you are using years. So this 1 to 10 will now be years. If you are using 14%, then this 1 to 10 will now be years. But if you are using the 7%, then it means that this 1 to 10 is 5 years, but it is semi-annual. Okay. So what would be the annuity for 7%? That will be 1 minus into bracket 1 plus 0.07 exponent negative 10 divided by the 0.7. What are you having?
7.024.
7.024. So if you multiply, what are we having?
Hello, sir.
Yes, please.
Please, so payment in advance. Are you not going to add the 1 plus 1.07 again? Multiply by 1.07 because payment is in advance, not in arrears.
You see, are we not going to add one?
I'm saying that are you not going to multiply this 1 by 0.17 because you are doing payment in advance.
We are not finding present value of all the amounts. We are only looking for what is the amount that we are going to be receiving from the person. That is the lease receivables. That is lease receivables. We are not looking at the present value of the amount that we are going to be receiving from person together with. We are not looking at the amount that we are going to be receiving from. Unless your this thing is giving me a very bad signal. The noise is not good. So if you are not talking, just kindly put your mic off. We are not looking at the present value of the amount that we are receiving from the person. No. We are looking at what is the present value of the remaining amount that we are receiving. That is the lease receivables. We are looking for lease receivables. Lease receivables. So the amount that we are yet to receive, that is the receivables. If you already receive an amount from a person, how would that be receivables? So this is not financial management that we are looking for present value of all the amount that we are receiving. No, we are only looking for the amount that we are yet to receive. Okay. What are we having if you multiply?
168.576.
Okay, 168 point what?
Hello.
Yes, please.
I'm a little bit confused. Can you please clarify the discount factor as 7% for me?
The 7% is the 14% borrowing rate for the person divided by 2 because it's semi-annual.
Okay. All right. Thank you.
Okay. Okay. So yes. So this is the remaining amount that we are going to be receiving from the person. Okay. But the person has already paid what? They have already paid 24. Okay. But if we are here to receive 168.58 from them and they have paid for what? 24. Then what is the value of the asset given to them?
We add this to 24.
Okay. So you have to look at the total amount relating to the receivable. So the total amount, that will be 168.5 here plus what? The 24. That is the value of the asset that we are giving to them. Okay. So that will give us how much?
192.58.
Okay. So this will be the 192.58. This is the value of the asset that we are giving to them. Okay. The asset, the right of use that we are giving to them, this is supposed to be the actual value, but they have paid 24 million already. Last time, what did we say about the direct cost? If you are giving the value of the asset, you can see that you are giving the value of the asset to be 154.57. That is the right of use of the asset that you are giving to them. Okay. And you also have a direct cost. What do we say about a direct cost? If you want to find any gain or loss, what do you do with the direct cost?
You add the direct cost to the right of use.
Okay. So the total assets, the total value of the assets that these people are going to be giving to them will be 192.58 plus 1. What are we having? 193.58. So this is the total value of the asset that we are leasing to those people. But what is the value of the asset in our books?
154.57.
Okay. So let's find a gain, or let's find a gain on that particular.
Please, before you proceed, where from the direct cost one?
It's in the question. If
Okay,
the BL incur and direct.
Okay, sir. Okay.
So let's come to this place. The value of the asset that we are given, the value of the asset that we are giving to the leasee now, which is the XY. The total value should have been the amount that they are here to pay plus the amount that they have paid. That would be 19168.58. That is the amount that they are here to pay plus the 24 that they have received. So it means that the actual value of the asset given to them is the amount that they are here to pay plus the 24. But we also incur direct costs. So since we incur direct costs, it will just be like we are treating it as right of use. So we are adding the direct cost to the right of use. So our gain on this particular transaction will be 193.58 minus the asset that we are giving to them, which is 154.57. What is the gain on this particular transaction? I'm having 39.01.
That's 6.01.
Is it 36?
39.01.
39. Okay. 39.01.
Hello.
Yes, please.
The other time you explained why interest should not be charged on the direct cost. I've forgotten. Can you please?
I'll do that again. I will still calculate the lease receivable for 6 months. Okay.
All right.
I will do that again. Okay, so I'm getting 39.01. These are all on July 2021. Are we okay with that?
Yes, sir.
Okay. So this can also suppose that the BL is carrying the asset at a revaluation model. Okay. So let's come here. We are not going to be having right of use in the books again. The right of use will be replaced by lease receivables. Okay. But let's come to the subsequent measurement of this transaction. We are doing all these things on July 2021. Okay, let's come to December. What will happen at December 2021? So December 2021, the lease receivables will now be, so we have the lease receivables. What is the lease receivables? What is the lease receivables?
192.58.
No, please. What is the present value of the amount that we are here to?
168.
8.5576.
What is the amount that we are here to pay? We are here to receive from the what? The X.
168.58.
168 point what?
58.
We want to calculate the interest. The interest will be calculated on only the amount that you are present value. So the interest is on only this amount. There's a total amount that we present value to have 168. So it is only this amount that we are going to be increasing. The direct cost is not part of the 168. So the direct cost, we are not going to calculate any interest because the direct cost has not been present value. We haven't factored direct cost when we are calculating the present value of the receivables. So there's a certain amount in the future which has been present value. So at the end of every year, we have to increase it. We have to increase it. So this is the amount that we are going to be calculating the interest on. The 24 has already been paid. It's not part of the receivables. Okay. So we now come to the finance income. These people do have a finance income. Okay. The finance income will be 7%, which is every year, 7% on 6.28. What are we having? 7% on 168.28. What are we having?
Is it 285 or 58?
It's 58.
24.
The figure you put in the bracket is not correct, sir.
Is 0.07 multiplied by 168.
8.58.
0.58.
And you rather correct 28.
Okay.
11.81.
11.81. Okay. Would there be any renters at the end of December? Would there be any renters at the end of December?
Yes.
Okay.
It's 11.801.
Okay. Are these people going to be paying any renters? Are we going to be receiving any renters?
There should be renters.
Okay. So the renters will be paid. The second one will be paid at the end of December. So 11.80. Okay. 11.80. What is the remaining figure?
$156.38.
Okay, 156.38. So this is the lease receivables at the end of the year. But what will happen is that the direct cost, since it's a direct cost, which is not receivables, it's not part of receivables, it has to be consumed over the what? Over the lease period. So you can do amortization of the direct cost. So that will also be amortized. If you are accounting for it as part of the PP, you see that it will be part of the PP to be depreciated over the lease period. So we have the amortization of direct cost. That will be 1 million divided by what? 5.5 multiplied by 6/12. The 5.5 is every year, and we are doing only 6 months of that. So we have 1/5.5 multiplied by 0.5. Okay. I'm not having 0.09 million. Okay.
Yeah.
Okay. So let's now come to the financial statement of BL, profit or loss. A lot of things will happen. Okay. The first one is the depreciation for the 6 months. They have used the asset for 6 months before leasing it. So what is the depreciation for that 6 months? it is 14.0 what? 4. So we have 14.04. That is a depreciation. And they are still owing the what? The original lessor. So there was a finance lease of what? 24 points. Finance cost of 24 points. So we have a finance cost of 24.5.
24.5.
Okay. Then they are also going to be having finance income. You can net the two, but since we are just doing it, let's show it for. So we have a finance income of 11.80, which is the receivables. Then we also count to the direct cost portion, the one that we are amortizing. That will be 0.09. Okay. Let's come to statement of financial position. Okay, sorry, there is a gain on this particular transaction. We have a gain of 39.01. Okay, then let's come to statement of financial position. Okay, there will not be any right of use again, isn't it? There will not be any right of use. Are we correct with that?
Rent receivable.
Okay, it will now be lease receivables.
Lease receivable.
Will now be lease receivables. And that will now be 156 because the asset, we are not using the asset again. We have replaced the asset with lease receivables. So the next one will be the direct cost, which is the an amortized side of the direct cost. 1 minus into bracket 0.09. What are we having? Okay, 0.91. Are we going to be having lease liability? Would there be a lease liability?
If we still pay the initial result, yes.
Okay. We are not the original owner of the asset. So we are taking the asset from someone and we are leasing it. So it means that we are still indebted to what? To the original. Okay. So we have liabilities here. So the only difference over here is that you continue to account for, you will still be owing the original lessor, but the only thing is that you are not going to be recognizing right of use again. Instead of the right of use, you put the lease receivables there because you have sub-leased the assets. So this will be 154.51. 154.51. So the lease liability will be 154.51. Okay. So that is the first side of it, the B part. Okay. The A part, that is the A part. So for the year end, this is what we are going to be doing. You can see that they have combined leasee accounting, reassessment, and then lessor accounting together. Okay. You look at this question and say that this question is not plenty, so it's nothing. No. Try it and see. B, if B leased the building to Esther, XY for only 2 years, show the effect of the sub-lease in their financial statement for the year ended 31 December 2021. If it's only for 2 years, what will happen? If it is for 2 years, are we going to be having lease receivables? If it is for 2 years, if it is for only 2 years, are we going to be having lease receivables? If it is for 2 years, which type of lease is this one?
Operating lease.
This will be operating lease. So the right of use will still be there. So if it is an operating lease, the right of what? The right of use will still be there. So we'll still be using the right of use. So if it is an operating lease, the depreciation will now be multiplied by 2 because we'll still be using the assets. we will still be accounting for the right of use. We are not going to recognize the asset. So we still have the right of use in our books. We still have the right of use in our books. So we still depreciate the asset like normal. Okay.
Please, it was in which year we've sublisted the asset to someone?
2021.
So from the initial say, it will be after 2 years or 1 year?
It's after 1 year, after 1.5 years.
Oh, okay, sir.
Okay. So if it is, this will now be operating lease. Okay. So this is operating lease. It means that we are still going to be the original owner of the asset. So the depreciation of the asset will now be on full year. We depreciate the right of use on full year basis, which will be 14.05 multiplied by 2, because 14.05 is half a year. So this will give us 28.10. We will still have the asset in our books. The lease liability will also be there. But the only thing that we are going to be recognizing is what? Is lease renters. Is lease renters. So we are giving the asset to them 6 months, and they are paying 24 every 6 months. So we are giving it to them for the first 6 months already. That will be 24. They have paid the 24 renters, and they are going to pay additional 24 again. Okay. So in the statement of profit or loss, this is how this particular transaction will be shown. So we have a depreciation of 28.10, because we are still going to be the one using the asset. Operating lease, the lessor will depreciate the assets unless the lessor is carrying the asset under fair value model. It will be seen as investment property, which will be under cost model. Okay, so we still depreciate it for a full year. Then we now have finance costs that we are paying to what? To the original lessor, and that was 24.50. But what will happen is that we have a finance income. The finance income, not finance income, let me just say rental income. Okay, so the rental income, which we are receiving every 6 months, that will be 24 here. There will not be any gain because we are not recognizing this particular one. But the direct cost also will still be amortized, but just over 2 years. So the direct cost will be amortized over only 2 years. Okay, so that will divide by 2 over only 2 years. Okay, so that will give us 0.5. Okay, let's come to statement of financial position. We will now have assets. We have the right of use. The right of use will now be the original value, which is 168.62. 168.62 minus what? 28.10. Okay, then the asset, let's say asset, we are putting all the assets together, but this is supposed to be non-current. Then the direct cost of 0.5 will be a current what? Asset, because the remaining one will be consumed in the following year. But since I'm having assets, that is why I'm putting the direct cost also under the asset. Then we go to liabilities. We now go to liabilities. For the liabilities, we'll be having the lease liability. We'll be having lease liability of the original figure that we have. We first had, that was the 154.51. Then we now have what? We now have rental prepayments. Okay, because the people are going to pay the next rentals at the end of the year. So it means that they are paying 2 rentals within the 2021. But we have only only 6 months of it. So the prepayment of the rentals, which will be 24, they are going to be paying 48 within the year. But we have only given the asset to them for 6 months. But we have received 48. It means that they have paid 24 million in in advance, and that will be the prepayment of income. So the income prepaid is a liability. That's how you go about it. Yes, we are done.
Hello.
Yes, yeah.
When you have a right of use asset and you want to change it to receivables, what should you look for in the question?
You first of all ask yourself whether the sub-lease is a finance lease. If it is a finance lease, it means that you are now transferring control, insurance, and everything with the asset to the third party. So that third party will be the one to recognize right of use, not you. Okay. So you will now replace the right of use with the lease receivables. So the only way that you can replace is to ask yourself whether the lease is a finance lease. So if it is a finance lease, you are going to be giving the asset to the third party to use, and the third party will be the one to maintain, insure, do everything about the asset. So you have to remove the assets from your books and now bring the amount that you'll be receiving from that person. But if it is an operating lease, it means that the third party will not recognize assets. So you will still be recognizing the assets. And there will not be any receivable. So the only thing that you can do is to receive rentals from the person. Okay. All right, Cynthia, I hope you're okay. Or you have any other thing to say?
I'm okay.
Okay.
Thank you.
All right. So thank you all for coming. I'll see you guys. And the next topic will be financial instruments. Thank you all.
Please, sir.
Yes, please.
Thank
Please,
you.
sir.
Thank you very much.
Hello.
Yes, please.
Like our sister said yesterday that if we'll be having a class, this